The views, comments, and opinions of the following program do not necessarily reflect those of Morris Media Studios, morrismedialive.com, or its affiliates. Listener discretion is advised.
Good afternoon, ladies and gentlemen. Good afternoon and welcome to Mortgage Money with Shirley. You're on this Thursday, the 27th day of May. We are live and direct in the studios, the Morris Media Studios. So please, if you haven't, subscribe, log in, check in on your YouTube channel page, Morris Media Studios. Okay, please check in, subscribe, go there now, today, or Facebook Live right here, right now. We are live right now with Mortgage Money with Shirley. Today's topic, we're going to talk more about that rental income and student loans. We're going to get into credit. We're going to get into debt to income ratios. And I've had a question about inherited properties. We're going to talk a little bit about all of those. It's a 30-minute segment. And we're live every first and third Wednesday or Thursday of each month. I'm trying to get it worked out to get on these Wednesdays, y'all, but life happens and the Wednesdays aren't going like I thought they would, but I refuse to let y'all down and not bring you the education on mortgages and refinancing and purchasing and all that good stuff with Mortgage Money with your girl Shirley. So we're here right now, and if you want to, you can leave comments on the Facebook page. I will promise you I will get back to each and every last one of your comments. So please go ahead, feel free, leave your comments, questions, concerns on that Facebook page, or you can call in right now at the studios. Yes, because we're live. So you can call in right now at the studios. We'll take your calls, questions, and comments and concerns at the end of the show. You can dial us right here at area code 323-815-4204. That's 323-815-4204. Call in the show. I'd love to talk to you and meet you. All right. So again, let's jump into episode 5. This is episode 5 with Mortgage Money with Shirley, and let's go. I've been getting questions and a bunch of questions and questions and a bunch of questions and questions and questions on what do I do if I don't have quite enough income to go get that property here in Los Angeles County. And I'm speaking to you all live and direct from Los Angeles County. So I'm going to talk a lot specifically about Los Angeles, the real estate here. And again, I get these questions about what do I do? Because I want to go buy a property in LA, but it's so expensive. Right? And my income will only allow a certain amount. So that's that part of that DTI, that debt to income ratio that we're going to talk about later on in the show. So what do you do? Here's where rental income becomes something that you can contend with. What do I mean? Well, Shirley, I want to buy this property, right? I make XYZ a month, a year. This is my annual salary. But the properties in LA are starting at $500,000. Okay, so you really can't qualify per se on the income that you're making, but you want to buy this larger size home, right? So what you can do if you're using FHA, right? FHA is a government loan. It's just like your VA loan. Those are your government loans. And what FHA specifically allows you to do is use some of that rental income that you will be collecting because you're going to buy a multi-unit property. Okay. Rental income only works if there's more than one unit, right? Because you're going to live in one unit when you first buy your property. You're a first time home buyer. You're going to live in one unit, right? And then you're going to have a tenant in the second or the third unit or the fourth unit. FHA will allow you to finance or purchase up to 4 units. That's still within the realm of residential lending on the FHA side, up to 4 units, okay? So you can buy the 4-unit property, you can live in a unit, and then you can have 3 other tenants that live and occupy these 3 other units. And all of a sudden, you went from the income that you're making, that you're eligible to buy a single family resident, let's call it $300,000. You've gone from a $300,000 eligibility of just a single family home to a $500,000 eligibility on a multi-unit home. You see how that works? Because these other units, you're going to be able to use that income that you're collecting from those other units, whether it's 2 units, whether it's 3 units, you're going to be able to use that income to supplement the income that you have just in your own annual salary. You're going to be able to supplement that income and buy a larger size property. So that's one way to qualify for more property than your income really kind of allows. Okay, so does that make sense? Let me go a little bit deeper with that. Let's say you're making $100,000 a year here in Los Angeles. There's a property that comes up. It's a single family, but it's a $500,000 property. Single family, 1 unit, single family, that's it. You qualify for $300,000, not the $500,000. So what are you going to do, Shirley? Oh my gosh, I can't afford this single family property. What do I do? So you can get a co-borrower or you can get a multi-unit, okay? Because your debt to income ratio, let's talk about that for a second. Your debt to income ratio, what we call the DTI, your debt to income ratio on the FHA lending side or VA, these government loans, we're talking right here about government loans just for a second here. So if you're doing an FHA mortgage loan and you're a first-time home buyer or you're just buying another property, okay? What you have to understand is that debt to income ratio, that threshold of what you are allowed to be at or under, never over, but under or at, that debt to income ratio for FHA government lending can go up to 50% most of the time. There are some exceptions to that rule. I have seen them go up to as high as 53%. Now, what is debt to income ratio, Shirley? So what it is the amount of the income, your gross income, the amount of gross income that you're making monthly versus all these debts that are going out on your credit report, okay? I get this question from time to time, and it never ceases to amaze me that what people have questions about, it's just second nature to me, right? Because I've been doing this business for years and years and years. So let me make sure that I am speaking to you all so that you clearly understand the differences between what is the debts that you are being counted for versus the debts that you're not, okay? So in this debt to income ratio, in this ratio, you've got the money coming in versus the money going out, right? The money that's coming in is based on the gross. Your gross income is that number. It's that gross number versus your net. The net is the end result, right? After FICA, after Social Security, after the state taxes have come out, after all of the taxes, and if you're in a 401k or whatever else, medical insurances, all of that stuff comes out of that gross top number. But then at the bottom is the number that we call the net. We don't qualify you off of the net. Thank goodness. We'll have a whole nother subject to talk about, and then there's less qualifications based off that net. So don't get confused and concerned. You've got the gross dollar amount, and that's before they start taking out the FICA, Social Security, medical insurance, blah, blah, blah. It's the number at the top of your paycheck. It's the bigger number, the gross number. That's the number that we use, okay? And like I said, I get that question from time to time that I hear people say, oh, I bring home about $3,000 a month. We don't need to know what you bring home. We need the number before the bring home number, right? So if you're bringing home about that $3,000 a month, you might gross about $5,000 a month, Okay, so we're going to take that gross number and then we're going to do that number against all the debts that are on the credit report. Only the debts that are on the credit report. And that's the question I get. So does my car insurance matter? No. Your car insurance is not on your credit report. So we're not going to worry about that number, that payment. We're only worried specifically about what's on the credit report, okay? So if you have on your credit report, here comes that topic we said that we're going to talk about earlier today. We're going to talk about the student loan. In that credit report, you've got your car loan, you've got Macy's, you've got Visa, American Express. These are the debts that we're taking in consideration when we talk about debt to income ratio. These are the debts. Your income is the gross. The debts are what's only specifically on the credit report, okay? Student loans, it's been a heavy topic of discussion because student loans, it used to be one type of scenario where they count these debts against you with student loans, and then it's been changing gradually over the years. A lot of clients want to know, well, I'm in forbearance, Shirley, and that payment doesn't count against me. Absolutely wrong. If you're in forbearance or if you have a deferment on your student loan, doesn't matter. We're still going to take in consideration a payment. But I'm not making a payment. They don't send me a bill. Guess what? We're going to do what's called a forced placement payment. That forced placement payment is going to go off of the outstanding balance of all of your student loans. So if you've got 5 student loans reporting to your bureau, each student loan has a balance, let's say $1,000 on each student loan. So you've got a conglomerate of $5,000 owed. We're going to take 0.5% of that $5,000 and we're going to say, okay, all together, you're going to owe about $250 a month. Now, it didn't used to be that way. On $5,000, they used to force place a payment at 1% of this outstanding balance. So now you're going to have to qualify off of a $500 monthly payment on that student loan, right? If your outstanding balance on that student loan, whether it's $1,000 on one student loan, $2,000 on the second student loan, $1,000 on the third, however many student loans you have, those outstanding balances are going to be multiplied at 0.5%. And like I said, this is good stuff. This is good stuff. It used to be 1%. Okay, so if you had a total outstanding balance on your student loan of $5,000, you would be counted for a $500 monthly payment. Now, yay, for the powers that be, now that $500 a month is $250 a month, okay? So now you have a little bit more purchasing power, okay? So that, again, this is all in this credit report, these debts that are talking about the debts to income ratio, right? These are your debts. And I also get that question, well, Shirley, I have a lease and I can just turn the lease back in. I'm talking about an auto lease, right? A vehicle lease. I can just turn that lease back in early. I don't have to keep it. So don't count that $500 lease payment on my Honda. Don't count that. Unfortunately, on a leased vehicle, we don't care if you turn it back in today, tomorrow. That $500 payment is still going to be counted against your debt to income ratio because it appears on the credit report. And regardless, leases are so hard to overcome when you're talking about these debt to income ratios because the lender knows even if you turn that car in tomorrow, you got to go to work some kind of way because you got to pay us, the lender. So how are you going to get to work? You're probably going to go get another car. So the leased vehicle, thinking that you're going to go turn it in, forget about it. Because if we take the application, the credit report application, if we take your credit application and there's a leased vehicle on there with a payment, that's the payment you're going to be counted against your debt to income ratio, okay? So keep in mind, that's so very important because I get asked that question from time to time about a leased vehicle versus a car note that is almost over with the payments. What are you talking about, Shirley? What I'm talking about is, let's just say that Honda, right? Instead of you leasing this Honda, where we absolutely have to count that $500 monthly payment, if you were buying this Honda and you only had 5 payments of $500 left, guess what? We don't have to count that payment. We don't have to count it. Boom, 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 boom. We don't have to count that payment because there is a rule in lending. Any installment any installment debt, as long as it's less than 10 payments left to go, we don't have to count it. You see? So again, there's a little bit of a perk when you're leasing a car or owning a car or buying the car. It's more of an advantage only in the mortgage world, right? In the mortgage lending world, it's more advantageous to show that you're buying this car, because when you get down to less than 10 payments, we don't have to count that payment anymore. But the leased vehicle doesn't matter. I don't care if there's one payment left. We're going to count it, right? Okay, because on that leased vehicle, like I said, they know, the lenders are so scared not to get their money. They know you're going to go out and buy another car. So keep that in mind. Leased vehicle versus buying or owning that vehicle. If it's less than 10 payments, we don't have to count it. But if it's a lease, we're going to count that payment every time. Now, let me jump back to the student loans, because again, like I said, I'm focusing on this credit report so that we can definitely talk to you about the debt to income ratio. I'm focusing on these debts on this credit report. So I want to jump back to the student loan, because there's one more question that I get also. I also get this question of, well, I'm going to call my student loan company and they're going to put me on an income-based program. The income-based program, I believe it's called an IBS. That income-based program is based off of the income that you're making right now. So they're going to take this, going back to that $5,000 that you owe on your student loans. They're going to take that outstanding balance, and when you call Sally Mae, I think it's not even Sally Mae anymore, but let's just say you're calling the U.S. Education Department, and hey, I need to get the IBS, and I want to get it based off my income. What do I do? And they're going to say, oh, okay. You owe us $5,000 and your income's $30,000 a year. So you're going to pay us $10 for the next 30 years. But guess what? That IBS program, we don't accept that in the mortgage lending world. Does nothing for us. If you have an IBS, we're still going to give you that forced placed payment, because guess what? Sooner or later, you're going to get off of this IBS, and then their big fat payment is going to happen, and then you're going to call the lender and say, oh my gosh, I can't afford this payment. What do I do? So no, always understand how the student loan works. It's okay to have student loans. It is okay to have student loans, right? And if you have 3 or 4 of them, I would advise that you call that lender and get them all consolidated into one student loan, right? So if you can, if it makes sense for you and your pockets, combine all your student loans together and get one student loan and get a real payment. Okay, right? Get a real payment. So that's what I want to talk to you about, that student loan. Now, let's jump into mortgages that are reflecting on the credit report, because I get this question too. During the pandemic, there's a lot of lenders out there saying, oh, you can forego 2, 3, 4-year payments. Don't worry about it. Pay us later. And that's exactly what they mean. Pay us later. But pay us. Key word. They had pay us before the word later. That meant they want their money before later ever showed up, right? So the thing about skipping those payments during the pandemic, and now you want to call Shirley because the rates are so low, I want to jump in on these lower rates. You call me and you say, hey, can we refinance, Shirley? And I'm going to say, have you made all those payments that you skipped? Have you paid them now versus later, right? Remember, your existing lender probably said, pay us later, but they said, pay us first. That meant they want their money. They want their money. So if you haven't caught up all those 2 or 3 payments that you skipped, you cannot refinance right now. Can't. Okay? Let me say that again. If you, during the pandemic, took advantage of what these lenders were saying about skip over your payments and pay us later, if you skip those 2, 3, 4, however many payments you skipped, before you call Shirley, make sure you are caught up and you've paid those 2, 3, 4 payments. You've paid them. And I know that sounds crazy, but that's what's going on in the market right now, right here, right today. There's a lot of people that are calling that want to refinance, but I'm telling them the same thing. Have you caught up those pandemic payments that you skipped? I know. So get your payments caught up. Now, another thing is, we've had clients that, let's say they did catch up all those pandemic payments that they were, said that they can pay them later. Let's say they've paid those payments. But what happened is, after they paid those payments, maybe they didn't have any money left over for the next month, so they skipped that month. Now what you have is what we call a 1 times 30 appearing on your bureau. See, the payments that you skipped during the pandemic, they're not even going to ding your credit. Not going to have no problem. Everything's going to be great. So you think. The problem with happens is there's sometimes we get clients that will call and say, I want to refinance. And I'll say, hey, did you take advantage of those pandemic relief payments? Probably won't say it like that, but nonetheless, I ask them, did you skip any of those payments? And oh no, I don't remember. How do you not remember that you didn't make a mortgage payment? But I get those calls. I do. I'm telling you real life situations. I get those calls. They say, I don't remember that I didn't make those payments. And know this, on your credit report, it's not going to have a negative mark because you didn't make the payment. So in a lot of clients' minds, they'll call in and try to say they don't remember because they know it's not going to be a negative mark on their credit report. But what you don't know is when we pull that report, it's not going to have a negative mark like you didn't make the payment. What's going to show is it's going to say in these little words, payment relief or financial disaster relief. It's going to have some verbiage. Oh yeah. It's going to have some verbiage that lets us know that you didn't make those payments. Even though the credit isn't dinged, it doesn't have a bunch of 1 times 30 or 2 times 30. It doesn't have any of those marks, but it has this specific verbiage that says something like, yeah, payment relief or financial disaster relief, something in those lines, right? And then also there's dates, right? So let's just say you didn't make your last 3 payments. Well, on the dates where it shows its rating, the dates will cut off. It won't be today's date, but it'll be the date 3 months ago when you stopped making the payment, right? And so that's what prompts the lender to go, oh, wait a second. The last time they made a payment was March 2020. Oh, so they've skipped all these other payments, even though your credit scores aren't going down, you're not getting dinged, but it says the last time you made a payment was March 2020. That's a problem. So that's how we know that you took advantage of those payment relief funds and you didn't make a payment and now you want to refinance and we're going to say, hey, did you make your payment? Did you get all caught up? And if you didn't get all caught up, we're going to tell you to get caught up and then call us back. But while you're getting caught up, you can't skip any more payments because now the payments that you are missing are now reflecting on the credit report. And that's how you end up what we call, like I said, a 1 times 30. Basically, it means that you didn't make a payment. So if you've got a 1 times 30 on your credit report and you want to do a cash out refinance, we're going to tell you, you got to wait about 12 months, right? If you want to just do a straight rate and term, you don't want to take out any money, okay, 1 times 30, that's fine. We'll go ahead and do your refinance before the 12 months, okay? But just know if you're trying to take money back, that's called a cash out. You can't really do that with a 1 times 30 on your bureau. So very important, before you decide to skip your mortgage payment, call me, okay? Call Shirley, call Mortgage Money with Shirley before you decide to skip your mortgage payment. Very important, okay? So now that we've talked about the credit report, we've talked about the debt to income ratio. Again, it's that gross dollar amount of income versus all the debts that are appearing on your credit report, not the car insurance, okay? Let's see, not your car insurance, not your health insurance, not your cable bill. A lot of clients ask me about that. Well, what about this cable bill? Is that going to be counted in my debt to income ratio? No, unless that cable bill is on your credit report, okay? We're only looking at the debts that's on your credit report versus this gross amount of income that you're making every month, okay? And at that point, we get a number. That's your debt to income ratio number. We're gonna take this number and see what you qualify for. It goes back to what I was saying about if you don't qualify for exactly the dollar amount that you want for this single family home, get you a multi-unit property so that you can use the tenants, the other people that are occupying those units, you can use their rental income money to help supplement your money and buy a larger property, right? Buy the property that you wanted. You wanted a $500,000 house, go get you a $500,000 multi-unit house, okay? So that you can use that rental income to help supplement your income, right? One more thing about that credit score, I want to talk about, about the credit report. I want to talk about your credit score, that FICO score, real quickly. It has now been lowered. It has been lowered again. That threshold for that FICO score, we can do 580 loans, 580 credit scores, 580 FICO scores. We can do those loans again. Now, they're government loans. I talk a lot about government loans and FHA loans and VA loans. I know I talk about that a lot because I really want to drive home the point that you can still get and own property even if your scores aren't high, even if your income isn't exuberant, even if your credit is so, you can still purchase a home. Call me because we've got programs for that. And they're government programs, but at the same time, you'll be a homeowner soon. So think about that. That 580 is a FICO score for FHA for government loans, okay? And that 580 is huge because during the pandemic, it was like 620. So now you can get a 580. So I want to talk about that. Real quick, I said I was going to talk about inheritances, inherited properties, right? So I get questions about inherited properties. In this latest scenario, I have a client, right, whose mom is not doing so well and she's up in age. So her mom has a trust. In that trust, it says upon death, you're going to be awarded this property. Now, what I told this person, because they really want to get some cash out to start paying for medical bills and blah, 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 on and on and on. So what you can do, true story, if there is a trust or a will in place, and if it's not, don't worry about it. But in the event that you have a chance to inherit a property and they put you on title, guess what? You can refinance tomorrow and pull out that cash as long as you have been on title and that person that is currently on title stays on title with you, right? So in an inherited case, right, the property has to be inherited. So you will need to show supporting documents, right, that says either the will or the trust says that they're going to get this property. However, if they haven't, if they're not deceased, add that person, add that son, that daughter, whomever, add them to the title. It becomes their inherited property and they can do a cash out refinance tomorrow because it's an inherited property. However, that person that is still alive, that parent, they still have to stay on the title, okay? So that happens all the time. Now, let's just say in the case that there's no title and there's no will or anything and the person passes on, right? Say that person passes on and there's no title, there's no will, there's nothing but this house. You, my friend, will need to go to probate court. And there's nothing wrong with going to probate court. But that way you have everything in writing of who gets what. Now, I know you all are familiar with that movie, Why Do Fools Fall in Love, with Lorenz Tate and Vivica Fox, right? That movie was real clear at the end of the movie. When Mr. Lyman passed on, all of these ex-wives and so-called supposedly wives start coming out the woodworks, right? And because there was no will or trust, well, I get half of that property, I get half of that property, and all I had to do is show up with a marriage license that said I was married to this man, right? So that's kind of what happened at the end of that movie. All these ex-wives came out of nowhere, but they were in court so that it specifically was awarded from the judge who got a piece of this property. And that is something that you want to have, in your archives, in your arsenal, because when these people come out of the woodworks, you want to say, court ordered, I get this property all by myself, right? You can't have a piece of it because it's mine. So it's very important. Nothing wrong with probate court, but get there so you can have the right documentation when the time comes. Everybody wants a piece of the pie, but make sure you're awarded your fair share of that pie. So when John, the great-grandson of the great-great-great-great-great-grandson, grandson's grandson, that person, when they come out of the woodworks, they can't come up to you and say, hey, Shirley, great-great-great-great-great-great-great-great-granddaddy said I'm supposed to be awarded some of that house. I can go, no, it's right here from probate court, right? So even if there is a will, even if there is a trust, most properties, most estates go to probate court so that they can have a clear understanding if there's anyone else that's supposed to have a piece of the pie, including who? The IRS, right? That's why a lot of people go to probate court, because they have to make sure the government gets their money. Yeah. So we're going to probate court, make sure all tax liens are handled, all child support judgments are handled. and IRS liens. That's why you go to probate court. And it's a great thing. It's not a bad thing, because what you don't want to do is become the sole owner of this property that's worth $500,000, but the IRS has a lien for $499,000 of it, right? Because trust and believe you me, you won't have this $500,000 house anymore. The government will have it because, you know. So make sure you go to probate court. But the difference between the probate court and all that fancy stuff over there versus the inherited property, while that person is still living, add son, daughter, whomever you want, add them to the title so that they can refinance if they need to pull out some cash for medical purposes or whatever have you, right? Okay, so I know today's topic, all these topics and all these segments, all these episodes of Mortgage Money with Shirley, they just go so fast. And our 30 minutes is up. I am on live streaming, though, every first and third Wednesday or Thursday of the month. And you'll always know in advance because I'll post something on social media telling you the day and the time. But again, any comments, questions, or concerns, please leave them on the Facebook or call in now. Got about another 2-3 minutes. Call in now at area code 323-815-4204. 323-815-4204. We'll be on for another 2-3 minutes, and I'll take your calls, questions if you have any. If not, I promise you I'll get back to those Facebook comments and let you know what it is that you need to know, what I know, okay? Again, Mortgage Money with your girl, Shirley. I've been a mortgage broker for over 28 plus years, it seems like. Love what I do. After the show, if you want to inbox me on Facebook, I'm under Shirley Nichols on Facebook, or my business page is Clear Sky Mortgage and Realty. Definitely jump on there, inbox me, ask me questions, or you can call me direct on my cell phone. I will answer. Area code 818-720-7575. 818-720-7575 is my cell phone number direct. But while we're waiting these last 2-3 minutes, I just want to make sure, let me check my notes, make sure I covered everything about the debt to income ratio. So very important on how you qualify for these purchases or these refinances, your DTI, your debt to income ratio. We covered your credit report about the student loan and the debts that are specifically on that credit report. And we talked about your inherited and probate. I also wanted to just give you a quick snippet about the 203K loans. That's another way of how you can get this dream home that you want with the income that you're using or the income that you qualify with, right? The 203K loan is a home improvement loan. That 203K loan, there are loan officers that are certified in 203K lending. I am not that certified lender. However, my colleague, I will be bringing on probably next time I'm on, which will be the first Wednesday or Thursday of June. The first Wednesday or Thursday of June, I will be bringing on my colleague that is specialized and certified. Oh dear, is somebody calling in? Oh dear. We'll take that call after the show. But we will be bringing in my 203K colleague, certified colleague that does this, specializes in the 203K home improvement loans. That means basically you see a $100,000 fixer upper house and you know with more money and you dump into this property to make it your dream home that it'll be something fantastic. So $100,000 home improvement, $100,000 fixer upper home, and you know the future value will be $300,000. To supplement that $200,000 difference in between, you get yourself a 203K or a home improvement loan so that you can fix your property up to something glorious. So don't think that you're here in Los Angeles and you can't find that one piece of property that really floats your boat. Go look at a home improvement, right? Go get a fixer upper house that maybe starts at a $100,000 sales price. I don't know what you call it. Maybe it's a $200,000 fixer upper. Get that property, get you a sales contract, a purchase agreement, get it signed and accepted by the seller, and do a home improvement 203K loan. And because the home improvement 203K loan is specifically geared toward you fixing up this property, they will qualify you off of that future value. So if the property, the fixer upper that you see is $200,000, but you know after you put about $100,000 worth of work in it, it's going to be worth $300,000. That's the future value number that the 203K loan program specializes in, that qualification off of that future value number, so that you qualify for actually more than what the house is worth at that present time. So we'll talk about the 203K. I'll bring in my specialist on the next time I'm on. Like I said, probably the first Wednesday or Thursday in the month of June. We'll bring on that specialist and we can ask questions and Q&A it the whole 30-minute segment, okay? All right, so that's my time. It goes by so quick. I love this podcast. But tune in, share with your friends, let them know we're talking about mortgages every first and third Wednesday or Thursday of the month. Let them know your girl, Shirley Girl, right here, Mortgage Money with Shirley, and YouTube streaming with Morris Media Studios. Bless you all. Have a great weekend. Be safe this holiday weekend, and I'll talk to you next month. Bye.